What's up, everybody? According to Adam, a leading curator of land, property, and real estate data, U.S. foreclosure filings are on the rise. This is one of the metrics we need to be watching so we can see the trends of our housing market moving forward. July's foreclosure activity reflects a slight shift in the housing market, said Rob Barber, CEO at Adam. With an 18% increase in foreclosure starts and a 14% rise in completed foreclosures from last month, these shifts may highlight growing pressures in certain areas. Monitoring these next few months will help us better understand the implications for the real estate sector. Back in 2008, foreclosures and short sales were everywhere, bringing home prices down dramatically as inventory rose and distressed sales increased. Could this be happening again? Do you see a lot of foreclosures where you live? If you do, put it in the comments and tell us where you live. As we know, real estate is very localized. Some states are showing higher foreclosure rates than others, but the overall trend is shown in the data. So today, we're going to take a look at the most recent foreclosure activity and see which states are the most vulnerable to a possible housing market crash and what the overall trend is moving forward so we can gauge the future of our housing market. So let's dive right in. On August 15th, Adam released its July 2024 U.S. foreclosure market report, which shows there were a total of 31,929 U.S. properties with foreclosure filings, default notices, scheduled auctions, or bank repossessions, up 15% from a month ago and up slightly 0.2% from a year ago. Not only are foreclosures up in July, but in the first quarter of this year as well. Q1 2024's foreclosure data reveals a market in transition, with slight increases in filings and starts alongside a notable decrease in REO property, explains Rob Barber, CEO at Adam. The reason these metrics are so important is because they reflect the trends and the future of our housing market. More foreclosures means more inventory, which can lead to lower home prices and alter the balance between supply and demand. They can also make neighborhoods less desirable since they are frequently left vacant for extended periods, which can lead to neglect and disrepair. This can cause a decline in the quality of a neighborhood, making it less attractive for potential buyers and further driving down property values. I mean, think about it. If there are several foreclosed homes in your neighborhood, all sold at a discount, which is common for foreclosed homes because they're usually in pretty bad shape, this can lower the overall property values in your neighborhood by creating new comps at a much lower price. This can affect appraisals for new sales as well as refinances. Not only that, but seeing a bunch of distressed properties in the neighborhood can be a real turnoff for home buyers. Foreclosure signs can make people nervous about buying a home. If they think home prices will keep dropping, they'll hold off on buying, which can stall the market even more. So, to no fault of your own, your home will go down in value as well. This can result in a downward spiral where declining home values lead to more foreclosures, further depressing the market. The problems caused by foreclosures can spread beyond the housing market. They can also serve as a barometer for a broader economy. High foreclosure rates often signal economic distress, such as rising unemployment or an increase in homeowners unable to keep paying their mortgage payments. Losing a home is stressful and it can disrupt lives and tear apart communities and create a general sense of instability. There is one group of people, however, who love foreclosures, and that is investors. Investors often see foreclosures as opportunities to buy properties at a discount. They love scooping up all those homes for cheap. These properties usually sell for less than what they're worth, so it's like getting a great deal at a sale. They might fix them up and flip them for a profit, or they could rent them out for a steady income. If investors turn a bunch of foreclosed homes into rentals, it can shift the neighborhood dynamic from mostly homeowners to more renters. This can change the feel of the community, impact local services, and even affect long-term property values. And sometimes an investor frenzy can drive home prices up. When there are lots of foreclosures, more investors jump in, hoping to cash in on those low prices. This can increase competition among the investors, which might drive up the prices of foreclosed homes, even though they are generally still below market value. But not all investors are bad. Sometimes when investors buy up foreclosures, it can help stabilize a shaky market by reducing the number of unsold homes. And some investors are really good at flipping homes. They actually care about the product. If you are one of these and you want to find foreclosures in your area or actually anywhere in the country, or if you're simply interested in foreclosed foreclosed homes? I put a link in the pinned comment below. Check it out. It'll help you find foreclosures anywhere in the country. Back to the data from Adam. Nationwide, 1 in every 4,414 housing units had a foreclosure filing in July of 2024. States with the highest foreclosure rates were Delaware, 1 in every 2,214 housing units with a foreclosure filing; Nevada, 1 in every 2,245 housing units; Utah, 1 in every 2,289 housing units; New Jersey, 1 in every 2,607 housing units; and Illinois, 1 in every 2,660 housing units. Metropolitan areas with a population greater than 1 million people with the worst foreclosure rates for July of 2024 are Las Vegas, Nevada, 1 in every 2,089 housing units; Philadelphia, Pennsylvania, 1 in every 2,197 housing units; Jacksonville, Florida, 1 in every 2,274 housing units; Chicago, Illinois, 1 in every 2,279 housing units; and Riverside, California, 1 in every 2,556 housing units. And like I said at the beginning of this video, it's only getting worse. Lenders started the foreclosure process on 21,870 U.S. properties in July of 2024, up 18% from last month and up 4% from a year ago. States that had the largest number of foreclosure starts in July of 2024 are California, 2,342 foreclosure starts; Florida, 2,339 foreclosure starts; Texas, 2,222 foreclosure starts; Illinois, 1,221 foreclosure starts; and New York, 1,145 foreclosure starts. A foreclosure start refers to the initial step in the foreclosure process, which occurs when a lender officially begins the legal proceedings to repossess a property due to the homeowner's failure to make mortgage payments. One of my lender friends loves to explain it like this: you don't pay, you don't stay. Major metropolitan areas with a population greater than 1 million had the greatest number of foreclosure starts in July of 2024 include New York, 1,286 foreclosure starts; Chicago, Illinois, 1,555 foreclosure starts; Philadelphia, Pennsylvania, 782 foreclosure starts; Miami, Florida, 758 foreclosure starts; and Los Angeles, California, 689 foreclosure starts. And the number of repossessed homes by lenders is also up. Lenders repossessed 3,282 U.S. properties through completed foreclosures, or REOs, in July of 2024, up 14% from last month and down 2% from last year. By the way, REO stands for real estate owned and is a type of property that's gone through the foreclosure process and is now owned by the lender, usually a bank, rather than an individual owner. If you have a lot of REOs in your area, it can greatly affect home prices. REOs are often sold at a discount because banks want to offload them quickly. When a lot of REOs hit the market, this can lower the overall price of the homes in an area, as buyers compare these discounted properties with traditionally sold homes. Investors love REOs because they can usually get them cheap and then either fix them up and flip them or keep them and rent them out. This can help spruce up neighborhoods, but if too many investors start turning these homes into rentals, like we talked about before, it can change the feel of the community from being owner-occupied to more rental-heavy. For home buyers, REOs can be a good opportunity to purchase a home at a lower price, but they should be ready to make some repairs because these homes are usually sold as is. It can be a great opportunity for first-time buyers or those looking to stretch their budget. Just know they usually do need a lot of work, and the bank will not pay for any repairs even if you do an inspection. States that have the greatest number of REOs in July of 2024 are New York, 377 REOs; California, 370 REOs; Illinois, 221 REOs; Pennsylvania, 219 REOs; and Michigan, 212 REOs. The major metropolitan statistical areas, or MSAs, with a population greater than 1 million that saw the greatest number of REOs in July of 2024 are New York, 271 REOs; Chicago, 176 REOs; San Francisco, 104 REOs; Detroit, Michigan, 100 REOs; and Los Angeles, 97 REOs. Although these foreclosure numbers are up, home prices have risen so much in the last 4 years that a lot of these homeowners do have a lot of equity in their house. So it can stave off foreclosure if you can sell your home before getting so behind on your mortgage payments. Soaring home prices seem to continue and have spiked the value of homes across the nation, which boosts equity for homeowners at virtually every stage of paying off mortgages. Monitoring these next few months will help us better understand the implications for the real estate sector. Rob Barber, CEO of Adam. And although foreclosure stats are up for July of 2024 compared to last month, they are still down from a year ago. In contrast to the first half of 2023, foreclosure activity across the United States experienced a decline in the first half of 2024, stated Rob Barber, CEO for Adam. A total of 369 U.S. properties started the foreclosure process in the first 6 months of 2024, down 3.5% from the first half of last year and down 32% from the first half of 2020. REOs are also down from last year. Lenders foreclosed, REO, on a total of 18,726 U.S. properties in the first 6 months of 2024, down 17% from the first half of 2023, down 10% from the first half of 2022, but up 92% from the first half of 2021. I believe that was because there was a foreclosure moratorium then, but still 92%. And compared to the pre-recession averages, foreclosures are way down. The national foreclosure activity total in Q2 of 2024 was 68% below the pre-recession average of 278,912 per quarter from Q1 of 2006 to Q3 of 2007. The bottom line is we need to pay attention to foreclosure activity, as it can serve as a key indicator of where the housing market is heading. Let us know if you see a lot of foreclosures in your area. Don't forget to tell us where you are. And like I mentioned earlier, if you are interested in foreclosed homes, I put a link in the pinned comments below that will help you find foreclosed homes in your area or any area in the country. So check it out. I hope you got some value to today's video. If you are interested in more videos about foreclosures or the housing market in general, check out these 2 videos next. Thanks for watching. I do appreciate it. Bye.